Look at this chart for a moment. Price sweeps liquidity, shifts market structure, and then delivers a precise move that repeats every single day. Yet most traders stare at the same chart and see nothing but noise. They mark random candles as order blocks, chase entries, and miss the real execution model that algorithms follow. The deeper truth is that price is not moving randomly. High-frequency algorithms are engineering liquidity and shifting the state of delivery at specific structural points. If you cannot recognize these signatures, you are trading blind. By the end of this video, you will understand the precise framework behind high-frequency order block signatures and how to identify them directly from market structure. Let's get started. For traders who are new to reading price action, the chart simply looks like noise. But look closely at this area of price. Right before this low formed, there was a swing high right there. Now pay attention to what that actually means. High-frequency trading algorithms actively use market structure. And they do this on extremely small time frames, 3-minute, 2-minute, 1-minute charts, and very often even lower intervals, 45 seconds, 30 seconds, even 15-second charts. So what are these algorithms actually doing? Here's the challenge I want to give you. Go back into your charts and study this behavior for yourself. Because once you know what to look for, you will start seeing these signatures every single day. And this becomes important later in the video. If high-frequency algorithms are operating continuously in the market, then their footprints must appear in price action. And they do. Now look at this short-term high right here. It forms just before the market creates that low. But here's the critical condition. When that high is taken out by this candle right here, it only becomes meaningful if the previous decline traded into sell stops. In other words, price must have moved below an earlier low. That earlier low could be a double bottom. It could be a single swing low, but the key idea is simple. Price has to move below a level that retail traders view as support. That is where sell stops are resting. Now focus on the highs above the chart as well. The same logic applies. When price trades above old highs, liquidity exists there. Many new traders assume those orders are unknown. But that perspective is flawed, and here's why. How do we know liquidity exists above those highs? It is simply logical. Look at the chart. Traders place buy stops above highs. That is how the market functions. Now watch what happens when price runs above these relative equal highs. This moment becomes extremely important, because when that liquidity is taken, you begin anticipating a potential shift in market structure. But here's where many traders make a mistake. You do not force the trade. You do not try to predict the shift before it occurs. Most traders simply do not have the experience to execute that way. Yes, there are methods that allow you to short directly above that liquidity. And there are also techniques that allow buying down here before the structure shift happens. But those approaches require far more experience, so instead, we focus on confirmation. Now look at the opposite side of the chart for a moment. See this swing low here. Let's revisit the earlier structure again. We have this high on one candle, then the next candle creates the highest high. And the candle after that forms a lower high. That simple three-candle formation defines a swing high. It looks simple. But when placed inside the correct context, it becomes extremely meaningful. Now watch carefully what happens next. When this candle breaks that short-term high, that moment becomes significant. But again, only because liquidity has just been taken. Once that short-term high is broken, the market now begins seeking additional buy stops. And where would those stops exist? Above these highs, above this high, and above this high as well. Now notice something on the chart. With just a few markings, we can highlight an area where sell stops are likely resting below price. This is visible even on the 15-minute chart. So price dives directly into that liquidity pool. At that moment you may not immediately know it is a buying opportunity. And that is perfectly fine. You do not need certainty. Instead, you anticipate the possibility of a shift in market structure. Now watch what happens next. Look closely at this candle right here. That moment is where your attention should increase. That is when you begin thinking, now the market might present an intraday opportunity, but we still want additional confirmation. And here it appears. The short-term high is taken. Price trades above it, and here is a key detail many traders misunderstand. Price does not need to close above that high. The trade through the level is enough. Now once that candle closes and the next candle opens, you begin monitoring this candle closely. And here is the question you ask yourself. Does this candle create a fair value gap? If the answer is yes, then a very specific condition now exists in the market. A fair value gap forms when price moves upward in a single pass. Then the next candle forms with a low that does not fully retrace the prior candle's high. That imbalance becomes important, and here's something extremely important to notice. This candle becomes the earliest location where a trade may be considered, because now a gap exists in price delivery. Watch what happens next. Price trades down into that gap, and then immediately accelerates upward. Now here is a critical insight about order block theory. Look at these down close candles here. All of them together represent one continuous order block. But what exactly is happening there? That entire series sits inside a pool of liquidity. Specifically, sell stops resting below prior lows. Now identify the opening price of that sequence of down close candles. Right there, that price level becomes extended forward in time. Now combine that with the fair value gap above it. Inside that imbalance, the opening price of the order block becomes your buy level. Plus a few pips to account for spread. That is where a limit order would be placed. And that is a very clean execution model. Now watch how price reacts afterward. The market begins running above highs where buy stops are located. Above this high, and above this high as well. Once those buy stops are taken, a swing low forms. And now the next question appears. Will price break that short-term low? Watch carefully. This candle drops below it. Now we have a new shift in market structure. But this time the shift becomes bearish. Why? Because buy stops were just taken from the market. Now another fair value gap forms. Price rallies back into that imbalance. And that is where a short position becomes possible. Now consider the targets below. Sell stops exist beneath this low, and below this low as well. There is also liquidity inside this fair value gap lower on the chart. Now if you are trading this move, you could take partial profits at various points. But realistically, the move below that low is not very large. So instead of exiting too early, you may choose to aim for the next deeper liquidity pool, which appears right here, and below that low as well. Now look at this area in relation to the range between this high and this low. The 50% level of that range sits right here. That is equilibrium. And this fair value gap aligns directly with that level. So the first objective becomes the low of this candle. That is the high end of the imbalance. That is your target. You are simply aiming for the easiest objective available. This is what we call low-hanging fruit. You are not trying to capture every possible pip. Over time, as your experience grows, you may hold trades longer to see if the gap fills completely, but that skill develops gradually. Now step back and consider what this process actually teaches. First, you identify liquidity. Second, you observe how price reacts to that liquidity. And third, you allow the market to reveal its intention. You never know the outcome beforehand. You only know when the market shows its hand. And this is exactly what you are seeing here. Now focus on this swing low again. Price breaks lower. Then it rallies back up into the fair value gap. And immediately sells off again. Another fair value gap appears here. Price retraces into that one as well. Remember, this is only a 1-minute chart, which means the market provides multiple execution opportunities. Now notice these two candles right here. Together they form one consecutive bearish order block. And again, the opening price extends forward in time. Why is this considered a strong bearish order block? Because it aligns with three conditions. There is an imbalance, liquidity was taken, and a market structure shift occurred. That combination creates a high-frequency, high-probability order block signature. Now let's answer the most common question traders ask. What exactly is an order block? An order block is simply a change in the state of delivery. Before that change occurs, price is being offered higher and higher through a sequence of bullish candles. That sequence begins with this candle's opening price. Once price trades below that opening, the delivery model changes. So the algorithm references that exact price level again. That is why it becomes sensitive. The system remembers it. The same principle applies on the downside. All of these downward candles represent a sequence of sell-side delivery. That sequence also begins with an opening price, Once that opening price is violated, the delivery state changes again. Now the market begins offering buy-side liquidity instead. And what does that mean in practice? Price begins seeking buy stops. Until that opening price is violated again, then the delivery state changes once more. Now the market begins offering sell-side liquidity. And price starts moving lower, attacking sell stops beneath prior lows. Eventually price moves toward the 50% level of the range. That equilibrium level appears right here. And notice how the imbalance aligns with it. If you zoom out to a 2-minute chart, that same imbalance appears as a single candle opening. On the 1-minute chart it appears as two candles. This is why moving between the 3-minute, 2-minute, and 1-minute charts becomes useful. Each perspective reveals additional structure. Now look again at this 1-minute chart example. The swing high is broken, market structure becomes bullish. Price rallies. Notice these highs forming beneath resistance. This is liquidity engineering. Traders believe the level is resistance, but what is actually happening is liquidity is being built above the highs. So when price finally runs above them, buyers enter at the worst possible price. And that liquidity becomes the exit point for smart money. Those institutions that bought earlier at lower prices use those buyers as counterparties. They sell into their orders. The logic is not complicated. It simply appears complicated when viewed the wrong way. Many traders believe every down-close candle represents a bullish order block and every up-close candle represents a bearish one. But that assumption is incorrect. Look here. This candle is the true order block. Price trades into it and rallies. Now examine the decline here. If you move to a 2-minute chart, this entire section becomes one single order block. So ask yourself honestly, is this difficult to see once it is explained clearly? The structure becomes very clean when distractions are removed. Now think about how to apply this practically. First, focus on the London session. That session runs roughly from 10 a.m. to 5 a.m. New York time. Identify the highs and lows formed during that period. Those levels are extremely important, because the market often sweeps above or below them later. Now do the same thing with the New York session. That window runs from approximately 7 a.m. to 10 a.m. New York time. Mark the highs and lows formed during that period as well. Then repeat the process for the Asian session, which runs roughly from 7 p.m. to 9 p.m. New York time. These 3 time windows provide the most useful liquidity levels. Additionally, watch for highs or lows forming just before the equities open at 9:30 a.m. That time often creates important intraday turning points. Generally speaking, the most active trading window occurs between 8:30 a.m. and 11 a.m. New York time. Sometimes the move extends toward noon. Personally, I avoid opening trades after noon New York time. Now remember another concept discussed earlier, internal range liquidity. This simply refers to short-term highs or lows forming within a retracement leg. Those levels contain stops, and they frequently align with imbalances within the same price range. Once you understand market structure shifts and learn how to identify liquidity pools, you already possess the essential skill set. The rest comes from practice. Study historical charts. Focus on the specific time windows discussed today. Mark liquidity pools. Annotate your charts. Over time, your brain begins recognizing these patterns automatically. The experience may initially be simulated through backtesting, but that repetition trains your mind, much like a hunter studying tracks before entering the field. You learn to recognize the environment before the opportunity appears. That's it, traders. Thank you for watching. I hope this explanation delivered greater clarity and practical insight that you can apply to your own trading. Make sure to subscribe and turn on notifications so you never miss future content. Leave your questions and suggestions in the comments section below. Let us know which topics you would like to see covered next. We truly appreciate your support, and we look forward to seeing you in the next episode.